quick introduction. We're a research and money management firm. We've been publishing independent research since 1975. And the first stock the stock that I'm going to be discussing today is Scotts Miracle-Gro, ticker SMG, which is a name we've been profiling, and full disclosure, we own it since 2011, I believe. It's been quite a good investment, and I think the stock right now is at a very attractive entry point for long-term patient investors. And I'm happy to go over the investment thesis with you, and happy to also make our recent report available to your listeners.
Yeah, in fact, I'm already sharing the screen. I think you guys can see it. So talk us through it. This is obviously a consumer staples company, but there's another element here, if I'm not mistaken, with cannabis, right? That's kind of like and this is a kind of a new development. Maybe tell us about that a little.
Yeah, absolutely. Just a very brief background on the company. It has Coca-Cola like market share in its traditional business, fertilizers, seeds, etc. It's a very good business that was significantly aided by the pandemic. It also, as you mentioned, has a cannabis business, and this is almost like a gold miner play. The people who made money in the gold rush were the people who provided axes and shovels, picks and shovels, that type of thing. And in terms of what they do is they provide, all things hydroponics, and they're the largest one out there. This was actually started by the CEO's son in 2016 or so, and they've done a great job of growing that business. And the share price, it was about $253 in April of this year. It's now down to about 150 or so and change. And part of that, it's hard to prove, is somewhat related. If you look at cannabis stocks over that time period, they're down, fairly significantly if you look at any of the kind of major ETFs. So I think in sympathy of cannabis stocks going down, Scotts shares have also gone down as well.
Interesting. What is the cannabis business exactly?
They provide lighting solutions, anything that you have to help grow the plant. They don't touch the plant. They're not growers of it. They provide kind of all the back end type of things that you would need, air filtration systems, that type of thing. It's not, it has nothing to do with growing cannabis. So it's all the kind of hardware that you would need.
And that's specific to cannabis plants as opposed to other things you might grow indoors?
I think they sell it to both, but it's primarily the growth engine, really. And the division called Hawthorne is primarily cannabis.
Interesting. And it's worth pointing out here, we hear a lot about cannabis legalization, but there's a difference between, or decriminalization, I should say, and I guess legalization in some jurisdictions, maybe not in the US, but there is a difference between decriminalizing cannabis use and then allowing people to actually grow the plants on their own. And if I'm not mistaken, the latter one of these is a little less stringent. That there's more people who are, it's more widely permitted to grow these things for personal use than it is to shop for marijuana products as a retailer, right?
Yeah, they've primarily been going, they go after both, but it's more of the larger kind of more industrial type of grower. These are pretty complex products, but they do for people who have home use as well. But a big catalyst for the stock will be the continued legalization through the US of cannabis. And it seems, because of the pandemic and we have massive budget shortfalls, et cetera, the government needs money. They have all these programs they want to enact. One of the ways that they're going to be doing that is through, legalization of cannabis and taxing it.
Very interesting. And now, what is behind the? You may have touched on it. I apologize. Behind the drop in shares this year, it looks like it was up at 250 halfway through the year, and since then it's dropped by about more than a fifth or a sixth even.
Yeah, no, it's been 250 to roughly 150 and change over a very short period of time. The first part, it's impossible to prove, but they are in a fair amount of cannabis ETFs, and cannabis people invest in the stock for cannabis exposure. And you look at the cannabis ETFs; they're all down fairly substantially. But probably the bigger reason is it's kind of a high class problem. Through the pandemic, their traditional business, the Scotts fertilizer, et cetera, was growing gangbusters. They had lots and lots of new customers who they've surveyed. About 86% think that they're going to stay, and they're investing in the business. So they have more capacity going forward. That's going to impact gross margins. So investors got a little spooked there, but we're comforted in the fact that the Hagedorn family owns roughly 26-30% of the company, so they're truly kind of owner operators of this business, and they're going to do what's right for the shareholders over the long haul. In the short run, anything can happen. They've proven to be fantastic capital allocators. They buy back stock when stock gets cheap. When stock gets expensive, they're more inclined to do special dividends or raising their dividends. So they're fairly good capital allocators. And one thing that they've also been telegraphing is they're probably going to do an acquisition in the not so distant future in their traditional business. But their acquisition history has been pretty good.
Wouldn't that be a short-term kind of headwinds for the shares, though?
Well, I think that they're more than reflected now from the 250 to 150. So yeah, I think they've corrected a little too much in that regard.
Interesting. And your report here, I'm just kind of scrolling through it quickly. It goes into the how the U.S. consumer business, and no surprise here, has benefited greatly from the pandemic, as we see people buying homes, more people buying homes. I mean, this is a pretty sticky business, one would expect, because and seasonal as well. Is that true, or has there been kind of a secular uptrend here in their consumer business that you've seen post COVID?
Yeah, it's interesting. The pandemic has been a big beneficiary for them. One, millennials, who everyone thought they were going to live in apartments forever, moving out to the suburbs, has been a big boon for them. And as mentioned earlier, we've been following the company since 2011, and I was just reviewing our old reports, and one of the things we were citing in 2011 or so were the baby boomers retiring. That would be good. They're going to go gardening, but it seems like millennials are even more apt to do gardening, especially in the live goods area, where they grow their own tomatoes, cucumbers, whatever it is. And that's been a real area of growth, and we think it's sustainable growth. I mean, if someone's going to build a garden in their backyard, most likely they're going to come in next year and do the same thing. They've already kind of put in the effort, etc. Scotts really has the best brand there for it. I mean, as I said, they have huge market share, and one of their competitors is who's mostly generic kind of Central Home and Pet, I think is the name of it, has said, writes in their filings, a big risk of the company is the big market share and big brand recognition that Scotts enjoys. So it's a real competitive advantage that they built up through the years.
Very cool. And it looks like here, like their marketing, which you get into a little bit in your report as well, is seeking to identify these people, partnering with VaynerMedia. Is that Gary V? And other social media elements to kind of get into this younger demographic, I guess. There was a class action lawsuit over over Roundup. Yes. I'm assuming over the pesticides. And I'm curious, because one of the things that millennials especially are concerned about, or say they're concerned about, and it seems that their consumer behavior bears this out, is kind of the whole ESG thing and environment. And does this company have any kind of quote unquote green products that it can kind of sell for that demand, or anything in the works there that you know of?
Yeah, I mean, they do have green products or products that are less harmful to the environment. They also have products in California that, you require less water to be used. But, if people want a nice lawn, et cetera, unfortunately, a lot of these safer products don't work as well. It's a little bit of a trade-off, but they do have, they do have obviously some ESG issues, and it's worth noting that the Roundup issue, they're a marketing agent for Monsanto Bayer. They're not, so there's no actual legal liability, although if they got rid of, it's a very high margin business for them. So it would be, a headwind if, that business goes away.
And you say here that they have supply chain expertise, and what you've seen from their reports and your potentially discussions with the company. Are there any supply chain concerns with this company, or are they perhaps even in a better position to weather them?
It seems like they're in a good position. I mean, obviously everyone's facing the same headwinds. The bigger problem for them are just commodity costs, urea, a couple of other commodities have obviously gone up in price, but they've been able to push through prices to consumers. They did one in, I believe, August. They could do another one in January. And this is one of the things that, as a firm, we're big believers of is in an inflationary environment, you really want to be investing in great consumer franchises because they have that pricing power. They can, pass along at least some of the pricing. If you're more of a generic type of company, you don't have that pricing power. So we think they should weather that storm pretty well.
Okay, very interesting. All right, I'm going through here the most recent quarterly. Do you know when the next quarterly is? Have they reported for this quarter?
Early November.
Okay, so not for a week or two.
Yeah.
Very cool. And I also like to ask about the balance sheet and how they're doing here with their debt load and payments like that. What's your take there?
Yeah, they, traditionally have had a lot more leverage than they have had that they do currently. The reason for that is business has been so good, they've let cash really pile onto the balance sheet. They have, raised, I think they raised about $400 or $500 million recently, and I think they're signaling, as I said before, a potential acquisition, but they're also taking advantage of the favorable environment for that. So I think the leverage is roughly 2.5 times or so, but they've operated at 3.5, 4 times before, so this is pretty modest.
Nice. And the free cash flow, of course, many analysts' favorite metric here has, and the company does throw off quite a bit of cash, but it says here that it's under temporary pressure, which may also be why the shares have dropped a bit. But you think that will be resolved and trend upward again soon, right?
Yeah, I mean, it's going to be a year or two. They're going to be investing in the business, which is the right thing to do over the long run. So yeah, it's going to temporarily affect free cash flow, but we think that's a 1 or 2 year issue, not a permanent issue. And it's worth noting that in a recent Barron's article, written by Andrew Barry, one of the company executives, really hinted that they're going to be aggressive buyers of their own shares. So while there is going to be less, free cash flow, they still will be buying shares at these prices.
And you have a price target of $244 a share, which is about 33% upside from current levels. There's a dividend here as well, so you do get a little bit of income. Can you tell us anything about that?
Yeah, I mean, they have, I think at these levels, it's roughly a 2% yield. They've increased their dividend over time. I think they'll continue to do so. They have a history of paying special dividends. So yeah, no, this is a well-run, good consumer franchise that, we think could, get upwards of, $250 a share and could go higher if things in the cannabis business, continue to accelerate.
And you've been in this company for a while, you mentioned, and it's one of your highest conviction ideas right now.
Yeah, it's definitely up there on the higher conviction. I mean, I would think at these levels, long-term investors will be, should be rewarded.
Very cool, very cool. And then lastly, my last question, I don't see any in the queue yet from the audience, but have you dealt with management? Do you have anything to say about that? Have you talked to them at all?
I mean, we are kind of the belief we don't really, we'll talk about it, ask some questions that we don't, might not be able to get the answer to, but we really rely on our own kind of independent work and, our own sources of information. Management, has their own axe to grind, and it's our kind of firm's research process to do everything kind of independently.
Fair enough. Good answer. All right, cool. Are there any questions from the audience? I believe this is your last chance because John is going to take off perhaps, or maybe he will be able to stick around. Here's a question. Hang on just a sec. Is App Harvest a client or a similar company? Do you know App Harvest?
I don't know them off the top of my head, so I sorry, okay. I can't answer that.
Yeah, sorry. Okay. Any other questions here? There is still time. If not, I will be sharing. There is a link that Jonathan has shared that I will send out so you can access this report. And thank you, John, so much for joining us today. Really appreciate it. And I think that'll do it from you. Really appreciate you coming in here and sharing this with us. And we'll now, as we get ready, Adam, are you all set for the next